Welcome to the Finance Club. In this video we are going to talk about the magic of the dividend snowball. So before starting, please like this video and subscribe to this channel for future updates. Interest gained on money that was previously earned as interest is known as compound interest. This cycle causes interest rates to rise and account balances to rise at a faster pace, a phenomenon known as exponential growth. Because a tiny snowball rapidly becomes a big one as it takes up snow while rolling down a hill, the idea is known as the snowball effect. The snowball, on the other hand, does not just grow in size at a steady pace as it rolls downhill, it actively accelerates its mass gain. This is because, as it grows larger, it acquires additional snow with each revolution, since the snow it acquired on the previous revolution is now touching the ground and taking up snow on top of the initial snow on the ball. This, we think, may be applied to high-quality dividend growth companies like the dividend aristocrats and dividend kings, which have raised their dividends for 25 or 50 years, respectively. By investing in excellent companies, you may harness the power of the snowball effect to increase your wealth and income many times over. While these wealth generators may be discovered in a variety of places, a good place to start is among the stocks mentioned in this article. A practical illustration. Compound interest is, without a doubt, the most potent wealth creation engine on the planet. Albert Einstein is said to have referred to it as the eighth wonder of the world. As an example, consider a $100 loan with a 5% yearly compounded interest rate. You would earn 5% on your $100 investment in the first year, leaving you with $105 at the start of the second year. However, in year 2, we are now receiving 5% on $105, resulting in a total interest income of $5.25 for the year. In year 3, we'd receive 5% on $110.25, for a total of $5.5125 in interest, and so on. Your $100 will have increased to $265.33 over the course of 20 years. Your investment would have only risen to $200 if it hadn't compounded, and instead had been paid a constant $5 each year. As you can see, compounding may rapidly lead to exceptional results, with compounding increasing profits by 65.3% over a 20-year period in this instance. Applying the snowball effect. How can you use the snowball effect to your assets to make compounding work for you now that you've seen how effective it is at increasing returns? We just need to look at Warren Buffett and his colleague Charlie Munger, two of the greatest investors in history. All there is to investing is selecting excellent stocks at good times and sticking with them as long as they remain good companies, Warren Buffett says. This apparently obvious statement really includes 3 fundamental investing principles: 1. Finding long-term compounders, 2. Locking in excellent compounding rates, and 3. Having the patience to let the snowball effect work for you. It's easier said than done to spot long-term compounders, but they all have the same characteristics: high returns on equity and strong and enduring competitive advantages that allow them to maintain their high returns on equity for extended periods of time. Why are these 2 characteristics so crucial? In the following quotations from Charlene Munger, she says, "Because it is the single most significant element in deciding what return you will get on your investment over the long run, return on equity is very important. Over time, it's difficult for a stock to outperform the company that underpins it. You won't get much more than a 6% return if the company returns 6% on capital over 40 years and you keep it for that long, even if you bought it at a big bargain. Conversely, if a company returns 8% on capital over the course of 20 or 30 years, even if you pay a high price, you'll end up with a fantastic outcome. You'll lose out on the full benefits of compounding if you have to trade in and out of equities on a frequent basis because they've lost their competitive advantages, and therefore their capacity to compound equity at attractive rates. If you purchase something that accumulates at 15% per year for 30 years, and then pays a single 35% tax at the end, the net result is that you retain 13.3% each year after taxes. If you purchased the same investment, but had to pay 35% of the 15% you earned in taxes every year, your return would be 15% minus 35% of 15%, or just 9.75% compounded each year. So there's a 3.5% gap there. And the impact of 3.5% on statistics over extended periods of time, such as 30 years, is really astounding. Snowball effect examples. Dividend growth companies are those that have the long-term competitive advantages needed to compound equity at high rates of return over extended periods of time. These are companies that have a track record of not just paying out excess cash flow to investors year after year, but also growing dividend payouts year after year. This results in a twofold compounding impact for investors, resulting in an exponentially increasing stream of dividend payments. In this situation, the investor's yield on cost, the amount of dividends received in relation to the original dollar amount invested in each share, rises every year, resulting in some spectacular wealth-building outcomes over time, as we'll see in the following instances. Number 5. Federal Realty Investment Trust. Federal Realty Investment Trust, FRT, a well-known retail real estate investment trust, is our last example. The trust, which was established in 1962, focuses on high-income, highly populated coastal areas in the United States, enabling it to charge more per square foot than its competitors. It has utilized its well-located and high-quality real estate, as well as economies of scale, as long-term competitive advantages as one of the biggest real estate investment trusts in the United States. It has been able to compound wealth at an amazing pace over several decades as a result of this. It has an excellent dividend growth record, with a yield on cost that has increased by 183% over the course of its existence. While this isn't as remarkable as the dividend history of the aforementioned instances in this post, it's worth noting that as a real estate investment trust, it's obliged by law to pay out at least 90% of its taxable revenue in dividends. As a result, it doesn't have as much money to reinvest in expanding its company. As a consequence, its dividend growth rate is considerably lower than that of a non-REIT, despite its overall total returns being similar. Number 4. Johnson & Johnson. Johnson & Johnson, J&J, one of the world's biggest healthcare and pharmaceutical businesses, is a fourth example. It was established in 1886, and now employs over 125,000 people worldwide. With annual sales exceeding $81 billion, it benefits from economies of scale, a wide range of product offerings, significant intellectual property rights, and significant research and development investments, all of which have allowed it to consistently compound wealth at high rates for investors over time. It, like the other businesses mentioned, has an exponential total return curve that is going higher. It also boasts a stellar dividend growth track record, with a yield on cost that has increased by an astounding 45,140%. Number 3. McDonald's. Next, we have McDonald's, MCD, the world's biggest publicly listed restaurant business. Since its founding in 1940, the business has benefited from the long-term competitive advantages of its strong brand name, economies of scale, and highly lucrative real estate-focused franchising strategy to continue to compound shareholder value for decades. This business also has a spectacular exponential total return curve that is going upward. And, true to tradition, it features an exponential dividend growth curve, with initial shareholders' yield on cost increasing by an incredible 33,460%. In 2008, the dividend was not reduced. Instead, the business moved from paying an annual dividend to a quarterly payout, which put this chart out of whack. Number 2. Lowe's Companies. Another excellent example of this kind of investment is Lowe. It was established in 1946, and is based in Mooresville, North Carolina. In the United States and Canada, Lowe's has approximately 2,000 home improvement and hardware shops. As the second largest home improvement store in the United States, it has benefited from the long-term competitive advantages of economies of scale and customer loyalty, allowing it to provide investors with double-digit annualized returns over the past several decades, with an exponential curve that is once again distinctly upward trending. Number 1. Coca-Cola. Coca-Cola, KO, is a typical example of a long-term compounder with long-term competitive advantages that has resulted in exponential profits for long-term investors. It has over 500 distinct non-alcoholic brands that it owns or licenses. Since its inception in 1886, the the business has expanded to more than 200 countries, with its brands accounting for about 2 billion servings of drinks each day and generating nearly $35 billion in annual sales. It has developed a strongly devoted following among customers thanks to its powerful name brand and great-tasting beverages, allowing it to charge higher prices and multiply investor equity at double-digit rates over time. What do you think about our video? Let us know in the comment box below. Please like this video and subscribe to this channel for our future updates. Thanks for watching.